set.
Well, thank you so much to the Tulare County Association of Realtors for having me back. I always take that as a vote of confidence that I didn't screw it up too bad last time. I'll try and keep an eye on the chat. So if you guys have questions along the way, feel free to stop me or drop them in the chat or whatever, and I'll try and address them in real time. But I think we should have time at the end for more questions to the extent that I stimulated something in the midst of our discussions. Let me share my screen for a minute. That way you don't have to stare at my face the whole time and we can look at some pictures together. The kind of broad punchline and summary, and I think we saw this again this morning when the GDP numbers came out, is that we really are in this kind of bizarre economic twilight zone where, you know, everybody is looking at all of the economic data through the lens of what it means for the Fed, right? When is the Fed going to be able to give us those rate cuts, et cetera? And through that lens, you know, every time we get a piece of good economic data, the market freaks out, right? Because they think that the Fed's not going to be able to cut rates, that rates are going to stay higher for longer. You know, people pull back from the bond market and we see those interest rates go down. Similarly, whenever we get bad economic news, less jobs, slower growth and incomes, things that we normally root for, the market actually likes that right now because they think, oh, great, economic weakness. That means we will get the rate cuts again. And so it's bizarre to be rooting for bad news on the economic front, but that just kind of underscores how much of a rate-driven environment we're in. And through that lens of kind of, you know, the economic twilight zone, I think, you know, the bad news is just how strong the economy still is, right? We've got, continued solid job growth in excess of 200,000 jobs a month. We just got a new GDP growth number this morning that has the economy expanding at close to 3% again in the second quarter, most of which is still being driven by consumer spending, and folks are still out there buying stuff, but increasingly really kind of fueling growth in the service sector, bars, hotels, restaurants, entertainment, et cetera. And the other kind of piece of bad news is just that the Fed's doing pretty much exactly what they told us they were going to do. And I think there's been a bit of denial, especially on the part of the bond markets. You know, yeah, they said they're going to take us to 5%. They're not really going to do that. But even if they do, they'll start cutting rates again quickly. And really the Fed has just kind of stuck to their guns and done what they've said they were going to do all along. And the bond market's been overly optimistic that they were going to start reversing course, I think, much sooner than was really realistic. So the bad news is that the economy is still really strong, and that's keeping inflation above that Fed target and keeping rates higher than we've seen now for many years. The good news, again, through this twilight zone lens, is that I don't think the economy is as strong as these headline numbers would have us believe. If you look at the jobs numbers in more detail and kind of go in past the headline number, you can see that there's really a tale of two economies starting to emerge where, you know, folks that are working in remotable high income jobs where they own stocks, where they own real estate are still doing really well economically, but folks making, you know, 60 grand a year or less are really up against it. And you can see that in terms of just the amount of debt that we're carrying around now. We've been spending, and consumers are really the only engine of growth for the U.S. economy right now, but increasingly we're just throwing it on the credit card. It's not being backed up by, you know, incomes that are kind of affording us all of these extra 80-inch TVs and $100,000 trucks and all that stuff. The other thing I think is that the office sector still has a long way to go, and all of these things spell, I think, a weaker economy next year, second half of this year. Has been the case up to this point, and why I think that we will probably get inflation in check and ultimately get a few Fed rate cuts this year. But I think the moral of the story for us is that it's just going to be a bumpy road to recovery. It's not going to be a V-shaped bounce back to the 510,000 homes that we were selling back when rates were at 2.75%. Things are getting better. They've already gotten a lot better, and we think they're going to continue to trend in the right direction. But it's not just going to be new highs every single month. The next piece of strong economic data is going to send rates back up. We might even see rates go above 7% again. And we've seen already the bond market kind of freaked out about this latest GDP number. So, again, things are moving in the right direction, but it's going to be kind of fits and starts, like one step forward, two steps back, because the market is just so hypersensitive to any new piece of economic data. The kind of bright spot right now, I think, is on the inventory front. We've seen that in Tulare. We see it across most of the state. Again, just how macro driven this stuff is. But we are seeing more sellers start to sell their homes, even though you got a lot of folks locked in at hyper low mortgage rates and really don't want to move unless they absolutely have to. We, of course, also have all these industry and practice change shenanigans going on associated with the settlement. So there's just a lot of wild cards out there. Fed, interest rates, macro stuff, the office sector, credit card debt, antitrust stuff or settlement related stuff. But I think as disparate as all of these challenges are, there's really only one answer to all of these things. And that's kind of true regardless of whether we're talking about when rates are going to come down or how do I get people to sign buyer broker. I think it's just being on your A game, right? Like I'm in the midst right now of selling my house, and then I close on the new one on August 5th. I am so in the weeds of real estate, like every day, just as part of my job. You're not going to find like a more informed consumer to work with probably than me, just because I do this as part of my job. And even I realize going through this, just like, consumers really need us now more than ever, right? The RPA is like 4,000 pages long, the negotiation, the tightness of the market and how competitive things are. I mean, people do not want to go through this stuff alone, but the kind of flip side of that is that it's just so incumbent on us to really kind of embrace that role as the expert and the trusted advisor and the kind of consultant in chief and all of that stuff, because the costs are a lot more explicit on the buy side now. And so you want to be able to have a whole litany of things that you bring to the table that justify that. I kind of equate it to like, the sports analogy, right? Like back before all these practice changes, like it was good enough just to be like the best shortstop in the world, right? You just had to be good at what you did, and that's what it really required. Now, I think the change is that, yes, you still have to be on your A game and be the best shortstop in the world. But now you have the kind of secondary challenge of also being able to communicate about why you're the best shortstop in the world, right? It's not just that you can make that diving catch and save the double or whatever. You got to talk about your philosophy of training and why you're the best and how you approach the game and all of the things that you do to make sure that you're there to field those grounders, et cetera. And that's like a whole different skill set. But, again, I think that it leaves us in a place where the good realtor who does a lot for their buyers and sellers, are probably going to do even better than ever moving forward, because there's going to be some folks that may not be as effective at communicating that value proposition, meaning that, market share has the potential to go up. But we just don't want to take our foot off the gas as individual real estate practitioners, because there's a lot of headwinds. There's going to be a lot of volatility. Things will keep getting better. But again, we've got a long way to go to get back to where we were a few years ago when rates were down at 3%. For the buyers that are sitting on the sidelines, I think we got to let them know that rates aren't going to go down dramatically over the near term. Meanwhile, prices only continue to get more expensive. And so you have this kind of brother-in-law effect, which I think I've told you about before, where everybody's brother's telling them to just wait for the foreclosures, wait for the 5% interest rates, et cetera. And I don't think that's going to happen. This is where I'm kind of glad that to be the data nerd of the group at C.A.R., right? Because I think this is actually an area where the data is really on our side. So hopefully you can use these slides to help kind of get folks less short run focused and more focused on the long term, because affordability is only getting worse. Even if rates do start to come down later this year, it's going to be more than canceled out by the increase in prices. So don't wait for rates. That's the bottom line. Things are going to get better, but it's still very much at kind of on your level, a nose to the grindstone environment, because we've got a lot of macro volatility. We've got all these practice changes. And so I think it's just all about bringing your A game. And if you do that, I think sky's the limit, regardless of all these challenges that we've talked about up to this point. Let's talk about the macro stuff. Actually, let me check the chat, make sure I'm not ignoring anybody. The macro stuff is really what's driving things right now. Like there's some variation area to area, and you'll see I brought the Tulare County market data, but more or less everywhere in the state's pretty much doing the same, just because it's such a rate-driven and kind of macro influenced environment. You can see that the Fed's still got the Fed funds rate up at about 5.5%. And I think the bond market is starting to finally come to grips with reality that they are going to stamp out every last ember of this inflation fire. It's actually pretty funny. If you look back at this chart in the 2 and the 10-year Treasury notes, even as early as the fall of 2022, when the Fed was still very much in the midst of their tightening cycle, we had about a 3.5% to 4% Fed funds rate, with them telling us very explicitly that they were going to take us to a 5.5% Fed funds rate to get inflation under control. But even as far back as the fall of 2022, you could see that the bond market started topping out, right? It got up to 4.5% on the 10-year, and it pretty much plateaued there on the, I don't want to say the assumption. It's really more of the optimism that the Fed wasn't going to take it to 5% and keep it there, but rather, start reversing course over the near term. And so they were always just waiting for that Fed rate cut that was always just right around the corner and never actually ended up materializing. And that's led to the volatility in rates that you've seen over the last 2 years, right? When we didn't get rate cuts by the end of 2022 and the economy continued to be really strong, you saw that 10-year shoot right back up to 5%, similarly on the 2-year, right? And then they got more optimistic that maybe you would get cuts, and the rates started coming down as people pour back into the bond market. Then we get a strong jobs and inflation number, everything reverses course. So right now we're at about a 4.5% 10 and 2-year. That's probably where rates should have been all along. The reason why the recovery has taken so long is all of this kind of over optimism on the part of the bond market, where we get these rate declines and they jump right back up on the next piece of data, has really kind of pushed out the real earnest kind of robust recovery, because that stuff filters right through to mortgage rates, right? If you take that 10-year and overlay it on mortgage rates, you can see that every time the bond market freaked out, we got this spike in rates. And every time they regained confidence about the rate cuts, then we got a reprieve. Fortunately, a lot of this noise has settled out, and that kind of 4.5% 10-year has helped us to get below 7% pretty consistently now for the last month and a half. But you can see how much higher rates still are from where we were a few years ago, and why we still have buyers that are kind of scared off, waiting for that 3% rate to come back, which I always say, you're probably not going to see any 3% rates ever again. And if you do, it's probably going to be because there's been a big economic catastrophe, not necessarily something you want to root for. In fact, rates right now are pretty much on par with historical averages. 6.5% is the norm, right? 3% was the kind of one in a lifetime wild card due to a global pandemic. The reason why the Fed is keeping rates so high, obviously, is because they want to get inflation under control. Inflation is just the kind of econ nerds way of saying the cost of the stuff that we buy, right? And you can see we've made a lot of progress. If you go back to mid 2022, we were experiencing our first real bout of inflation that we've really ever had since, the early 1980s, late 1970s. And we've gone from about 9% down to, if you kind of drill it down to 2 decimal points, we actually just dipped below 3% for the first time in about 3.5 years since this inflation first started ramping up. But I don't want us to over celebrate that positive number from June, where things finally dipped below 3%. If you look at the blue line here, you can see that we dropped pretty quickly from 9% down to about 4 to 5%. But if you look, the drop from 5 to 4, from 4 to 3 has taken even longer than it took to go from 9 to 4%, right? That last mile on inflation is the hardest to get rid of. The first piece of inflation was kind of easy to get rid of because it was really pandemic / shortage driven, right? We had factories shut down. We weren't putting cars and TVs on ships from China and getting them onto the car lots and into Costco here in America. We had toilet paper shortages and all kinds of crazy stuff happening that led to this kind of opportunistic price gouging. And that's really what kind of characterized the 9% inflation that we had back in 2022. This kind of last mile, you can see just how very slow and incremental the progress has been since last summer, because this last mile on inflation is really driven by two primary things. One is wage costs that are in turn driven by a very tight labor market, and the other one is housing costs, which really haven't come down very much at all, despite this jump in rates. And those are the two pieces of inflation that are the hardest to get rid of, right? And if you kind of look at where we are on the labor shortage, we had a lot of people both retire early, as well as people at the bottom end of the wage spectrum can't afford daycare, and so they're not working at fast food places anymore. That is really a kind of one-off, unique, unprecedented thing. As far back as the U.S. kind of Bureau of Labor Statistics has been tracking job openings, we've really never been in a labor shortage, let alone one that's as acute as it is right now. And when we have too many open positions and we don't have any workers to rope in off the sidelines, that means to fill my job, I've got to lure somebody away from their current job, and that means paying them higher wages, and that gets passed on to consumers in the form of higher prices. The good news is that the labor shortage has shrunk considerably, right? If you just zoom this last chart that I showed you into just the last couple of years, at one point back in mid 2022, we were running about a 6.2 million worker shortage. That has since improved to just 1.5 million workers short, but it's still a shortage, right? And so there's nothing that suggests that your brother-in-law's forecast of inflation immediately returning to 2% and getting 300-400 basis points of rate cuts, I think just isn't backed up by the data. The other thing is that consumers, even though most of it's going on the credit card now, continue to spend money, and that means that labor shortage persists. It means that the cost of the goods and services goes up, and that means that the Fed will be really loath to take their foot off the gas. And that's why I think even as buyers may be finally celebrating this most recent inflation report, they might be celebrating a little bit too early, because this last mile of inflation is going to be really sticky and hard to get rid of. It's like when you start going to the gym when you're really out of shape, losing that first 5 pounds happens almost overnight, but then you kind of grind for a year and the six-pack still never materializes. Like, I don't want buyers to think that this kind of validates their brother-in-law's forecast and that maybe those 5% rates really are just right around the corner. Yes, the market's improving. Yes, we're going to keep making progress on inflation, but it's going to be very incremental. And, even if we get Fed rate cuts, it doesn't mean that mortgage rates are going to drop noticeably from where they are now. Again, it's going to be very volatile, right? And you can see if you look when rates initially started going up in 2022, it only took about a month or two for buyer demand to really start falling off a cliff. Those mortgage applications followed suit very quickly as rates started to rise. But then you can see in 22 and 23, even small changes in rates, right? People thought that maybe we were at the top back at the beginning of 23. Rates started coming down. Even a 20-30 basis point decline in rates saw buyer demand come back pretty robustly. But when the bond market had its freak out and realized the rate cuts weren't right around the corner, rates went back up and buyer demand started to plummet once again. So even as I think we're going to move in the right direction, it's going to be a very bumpy ride. Now, I personally am not ruling out rate cuts. I know back in April, people had all but given up on any rate cuts this year. I still maintain that we were going to get one and maybe even two, and that looks increasingly likely now, although that probably won't be till September or November. I still think we're going to get those rate cuts, but I also think that we need to get serious about what that means for mortgage rates. And this idea of waiting around for rates making financial sense, I think, is misplaced. Interest rates are actually really easy to figure out mortgage rates, right? We have a Fed funds rate, which is kind of the risk-free rate of borrowing that banks can use to borrow overnight, right? And that really sets the kind of minimum floor for where long-term rates are going to be. Then there's another piece that we call time value of money opportunity cost, right? And that's this orange stuff here. But basically the idea there is that the longer you loan me money for, the more you're going to charge me for by way of interest, right? Because the longer you have your money tied up, the more risk you're taking on in terms of what I might do. I might die, I might go bankrupt, I might get hit by a bus, et cetera. You're also giving up other opportunities, right? You could buy Bitcoin, you could buy an index fund, you could put it in the stock market or what have you. And so the longer you tying up your money, the more you want to be compensated for that extra risk. And you can always add that on to the risk-free rate, as well as the private sector risk on top of that. We call the kind of time value of money piece the yield curve, right? That's just the longer term treasuries have higher rates than short run. There's also private sector risk, right? It's more risky to loan me, Jordan Levine, money as an individual than it is to loan the US government money by purchasing a treasury bond, right? And so again, there's this additional level of risk. Well, we kind of know from historic norms what that time value of money piece looks like and what the private sector risk premium looks like. The normal treasury market's about 100 basis points above wherever that Fed funds rate is, right? And the private sector mortgage spread is typically about 150 to 200 basis points. So we can just take those kind of normal averages on time value of money and private sector risk and add them on to what the Fed tells us they're going to do, right? We can argue about when the rate cuts are going to happen, but look at their long-term forecast, right? Once they've totally snuffed out inflation, they still plan on having a 2.5% to 3% Fed funds rate. Well, if you add on time value of money and private sector risk, it's hard to imagine a scenario, even over the long term, whether it's 25, 26, 2029, what have you, where rates are going to be, lower than 5.5%. I think the steady state's probably in that 5.5% to 6.5% range on the basis of a long-term risk-free rate of 2.5% to 3%. So rates later this year, next year, even over the long term, aren't going to be that much different than they are right now. If, I'm thinking best case, we're probably going to get down to maybe 6.3% late this year. More realistically, probably 6.5%. Well, if you kind of extrapolate that out and overlay what we could expect from the kind of demand side of the equation, that puts us back to where we were like 2022 levels, more or less, right? So it's better than it was earlier this year, better than it was during the second half of last year, but it's not a cruise control number where you can throw your business in autopilot and kind of take your foot off the gas. So transactions are going to be relatively low, and you can see we've already made significant headway on this kind of recovery, but you can also see how this most recent rate volatility has kind of stalled that recovery, right? Back in November, we were down at about 220,000 home sales statewide. In the first half of this year, that kind of rebounded to 280, 290,000 units, but then we've kind of stalled at 270, 280 now for the last 3 months as rates have been all over the map. So yes, we're moving in the right direction. Yes, we're pretty much up relative to last year, but you can also see if you look back the preceding couple of years, just how long we still have to go to get back to where we were. So yes, but don't over celebrate, right? If you look at it kind of by price segment, that's really where all the action is. The top end of the market statewide is punching above its weight. You can see that in the Tulare numbers. I'll show you in a second as well. The one thing though that I'll point out is that the top end isn't growing by so much now that it's canceling out the declines at the entry level, right? If you go back to earlier this year, 2 million and up was growing by 30, 40, 50% pretty consistently. It has started to really decelerate such that June only saw 2 million and up grow by 9%. So it's still outperforming every other market segment. And that's that kind of tale of two economies that we talked about, where the high income earners are still punching above their weight economically, but they're not just outperforming so much that it's kind of canceling out the lack of inventory below 400,000 units. If you look at the Tulare County numbers, and again, you have access to all this stuff, so if you want to show it to buyers and sellers out there, you can see the same kind of story playing out, right? Pretty robust sales during 21, 22. As rates really started to climb up, you saw those sales at the end of 22 fall off a cliff and stay pretty depressed through 23. But we've had a good spring home buying season in Tulare County, although we still, again, have a long way to go even to get back to the 2020 kind of levels of growth. The one good spot is obviously on the inventory front. We have more homes available for sale. That should help these sales numbers start to go back up, particularly as we've had a pretty decent reprieve on rates over the last month, and we've seen that start to send the pending numbers back up as well. I know those kind of price segment numbers weren't necessarily that applicable for Tulare County over 2 million, but even in Tulare County, you see the same kind of story playing itself out, right? If you go back even to 2020 and you look at like homes priced over 600,000, right? In Tulare, it used to be about 3% of all transactions. It's almost tripled. It was about 9% of the sales so far this year are above 6%. So even in Tulare, the top end, you know, those high income earners are buying the more expensive houses, 900,000, even a bunch of $1 million homes, which never used to show up back in the preceding kind of decade leading into this. So, you know, top end still doing well, but the numbers will probably soften as the amount of people that want to buy $1 and $2 million homes starts to plateau. Fortunately, and you know, this is kind of the first time since I've ever worked at C.A.R. where supply's actually been a bright spot. We put more homes onto the market in May and June than we did more or less in any month of 2023. That is a good thing because supply has been the limiting factor. We still have way too many buyers and not enough homes to put them in. This is really what underlies our forecast of a double-digit rebound, is that we're going to get a little bit more supply and we're going to move every one of those units that ends up showing up on the MLS. Why are people moving, right? I've been talking for the last 2 years every time I come out about the kind of interest rate lock-in effect and how many people are sitting out there under 4% rates, right? Like, even people like me, if you're like getting divorced and stuff, you still don't want to sell the house because you got such a sweet interest rate, right? But we have had people buying and selling over the last 4 years, even at, you know, the relatively depressed level of sales. The percentage of Californians that are below 4% has started to shrink a little bit, right? Under 4% has gone from 72% to just about 2/3. Meanwhile, the percentage of people over 5% has gone from about 11% of homeowners to about 17. So still a ton of people locked in under 4%, but there are people that we're not asking to eat that much by moving a kind of decent cohort, above 5%, about a third of the market's above 4%. But even those people that are locked in, we need to keep in mind that, you know, interest rates and the kind of financial piece is only one aspect of your housing decision, right? Life happens. We always call it the 3 Ds, right? Death, divorce, dislocation. You know, when life happens, sometimes you got to change your place, even if you got a great mortgage, right? And if you look, even just since the pandemic started, we've had 1.7 million babies born in California. We've had about 1.2 million people die and their families have to do something with that house. We've had about 1.1 million people pick up and leave California completely, right? The one I'm not showing you here, but that's, you know, obviously near and dear to my heart, is the divorces. And we're doing about 1 million of those a year as well. And so, you know, even if you've got a 3% rate, you know, it's like if your wife starts dating the bartender down the street, it doesn't matter how cheap your interest rate is, you do dump that property. Take my word for it. I close August 5th, right? So there will be more supply, even as it will remain true that many, many people are disincentivized from selling because of that interest rate lock-in. That being said, though, I still want us to not over celebrate and pop the champagne corks. Yes, inflation's going down and that will lead to lower rates, but it's going to be very gradual. Same thing on the supply front. People are starting to sell. Inventory is growing, but in Tulare, we're not even recovered back to where we were during the shutdown in March of 2020, right? So like, yes, things are moving in the right direction. No, don't go out and pop the champagne corks and think you can just kind of ride the wave to more business. It's still going to very much be nose to the grindstone, pounding that pavement for those listings. And this is one of the reasons why buyers should be incentivized to move, even though rates are kind of higher than what they got used to over the last couple of years. A, rates aren't going to come down that quick, but B, the market is still very tight, even as supply starts to improve. The other thing is, if you listen to your brother-in-law and your brother-in-law is wrong and you don't get a bunch of foreclosures hitting the market at 4% interest rates, you've just cost yourself a ton of money. If I'm wrong and you go out and buy a house right now and rates for some reason do fall to 5%, my bad forecast cost you nothing. You go out and refi, you get a lower payment. Now you just got a free BMW on the basis of that extra cash flow. Whereas if you listen to your brother-in-law and he's wrong, now you're facing 6.5% rates still at prices that are 8 or 10% higher than they are right now. And that is the double whammy for your pocketbook. So which way do you want to be wrong, right? Even if I'm a terrible forecaster, you still end up better off because you can go out and refi. What you can't do is like go back in time and start paying down principal and accumulating equity on a house that you didn't even own. And I think we need to remind buyers, would-be home buyers, like housing isn't about perfectly timing the market. And by the way, you already missed the bottom anyway. It's about the long term. You're already paying somebody's mortgage. It just happens to be your landlord. You're already building housing wealth. You're just doing it for your landlord. Number one best time to buy a house is it's 20 years ago. Second best time is right now. And that's because affordability keeps getting worse. As we're sitting here obsessing about where rates are going to go, we're on our 12th consecutive month of price increases, not decreases, right? So A, rates aren't going to come down that much in the future over the near term anyway. But B, if you're trying to pick out the bottom, you need to like jump in the DeLorean, punch it to 88 and go back to last winter because prices have already been rising every single month for a year straight. That's true in Tulare as well, right? We didn't want to buy in 2020 or 2021, despite the fact that rates were super low. And now the median home price in Tulare has gone from $250,000 to $385,000. So if you would have listened to me instead of your brother-in-law a few years ago, you would have just paid for both your kids to go to college for free by now, right? How long do you want to wait? What are these numbers going to look like in the future with supply and demand? I feel fairly confident that these numbers are only going to get worse. Meanwhile, the decline in rates is only going to get slower. This is what I meant when I said you need the time machine, right? If you want to hit the bottom in Tulare County happened last summer. That was the only time that prices were coming down. Since about July or August of 2023, prices in Tulare, they've even been going up longer than 12 months, right? So you already missed the bottom. How long are you going to wait, especially since rates are not poised to drop precipitously and there's really no prospect of any foreclosures happening, right? You can look at it both, not just in terms of price, which is now $385,000 in Tulare, but also just how competitive the market is, right? It used to take a month last winter for the house to hit the MLS and go pending. Now it's taken barely over 2 weeks, right? That's bad for you as a buyer. The market's getting more competitive. Supply is more constrained now, and you see that reflected in the price growth and in how quickly the homes are selling. You also see it in what they're selling for, right? You have more than half of properties in Tulare County right now selling at or above list price, right? Versus going back, to when rates first started going up, only 1 out of 5 homes was selling at or above list. Now it's half the market, right? So the longer you wait, the worse it's becoming for you as a home buyer, just in terms of price and competitiveness, and rates haven't really moved much, right? So this idea of waiting means saving, I think is just very misplaced. I do think we've been introduced a lot of systemic risk into the system. If you look at that kind of median household in Tulare County, they make about $74,000. You could take that at current interest rates and ask, what is the affordable price for somebody making $74,000 a year and facing, current interest rates and spending the right amount of money on a home? If you go through and do that calculation, home prices in Tulare should be about 340,000, not 380,000, right? And what that means is that in a kind of worst case scenario, and this isn't my forecast, we think prices are going to still keep going up, but just for the naysayers who think that the market's going to collapse, if that hypothetically were to happen, and there's no evidence to suggest that, but if it did happen, what would that equate to if prices fell back to that kind of long-term average? It'd be about a 20 to 25% decline in current home prices, right? So that seems pretty bad. So then why am I bashing and bagging on your brother-in-law so bad if prices in a worst case scenario aren't supported by incomes and could come down as much as 25%? It's because even if that does happen, you're not going to have very many upside down homeowners. Last time during the 2008 financial crisis, you had a lot of people come in with no money down, 5/1 option arm loans. And so when prices came down even a little bit, everybody was upside down, right? Even by 2013, when most of the foreclosures had already happened by then, you still, had about a third of homeowners with less than 20% home equity. If you look at where we were through the first half of this year, you're talking about 95% of Californians with a mortgage have at least 20% home equity. That's both because they put money down largely over the course of the cycle, but also because home prices have appreciated so much. In fact, you're talking about almost 90% of California homeowners have at least 30% home equity, right? So even in that worst case kind of wild card catastrophic economic environment where prices in Tulare revert back to that affordable price level and we see a 25% contraction, you've still got 88.6% of folks out there not upside down, and you don't throw the keys back to the bank on a house that's worth more than you owe on it, right? In fact, if you look at the whole mortgage market, and you include not just the people at 20 or 30% equity, but people with 40 or more, you can just see the amount of people with virtually no equity is negligible, right? You just don't have a lot of people that are back against the wall, ready and poised to throw their keys back to the bank, particularly since they have the lowest interest rate ever recorded in most cases and are kind of guarding that thing, holding on to it with a death grip, right? Even if I lose my job, I'm going to give up my car, my watch, my fancy vacations, and all that stuff way before I get rid of the house, both because there's equity in it, but also because of the rates. My payment is probably a lot lower than what it would cost to go rent something that's not even as nice as the house I currently live in. And lo and behold, you see that kind of dynamic playing itself out. Delinquency rates, the amount of people not paying their mortgage on time in California is 2%. That's way less than historic norms. You have 98% of people that are paying their mortgages on time. So I've got a boatload of equity. I've got the greatest mortgage rate of all time, and my bank's not even after me for any missed payments. To me, this kind of really is the dagger in the heart of your brother-in-law's forecast that we're going to get a big surge in REO inventory and a big decline in prices that would also come with a big reduction in rates. I just don't think we're going to have the inventory, distressed or otherwise, to facilitate anything other than ongoing price increases. And that's why, the number one best time to buy a house in California is a long time ago, but the number two best time to buy a house is right now. This is my number one favorite chart in the entire world. If you take every single American family and drop them all into a bucket and you line them up from the poorest family on the left to the richest family on the right, and you go in and pick out that very median family, the one right in the middle, that household has about $193,000 worth of net wealth. But if you take that same bucket and you separate it out and put all the homeowners into one pot and all the renters into another pot, it really tells you everything you need to know about why you should be trying to get into the housing market as quick as you can. Renters today are no better off and have essentially no wealth. And that's been true for the last 30 to 40 years. Renters never get any better off. Homeowners are the only people in this country with any wealth. The reason why the typical family in America has $192,000 is because we have a bunch of homeowners out there. If we were all renters, nobody would have any money, right? So forget trying to time the market. You can always take advantage of a lower rate. You can never go back in time and pay down principal and build up equity on a house that you didn't even own. You're already building wealth and paying a mortgage. You're just doing it for your landlord. It's as simple as printing out this chart and showing every gainfully employed renter, like, do you want to be blue or do you want to be yellow? It's really as simple as that. And that is what we do here. And that's why I love working for you. And that's why I remain optimistic, even with the volatility, even with buyer broker settlement stuff. People want home ownership. A lot of people don't connect the dots on why it's so important, though. And a lot of people think things are poised to get a lot better for them over the near term. And I simply think that's not the case. That's both our challenge, but also our opportunity, because we can get in there and evangelize and give people real information and get them off their brother-in-law's, email newsletter that has them scared off the housing market, and have, the potential to make change in our own environment, regardless of what the Fed does, right? So we don't have to wait on rates either. If you look at the forecast, the good news is that the market will largely be at our backs this year instead of a headwind. But again, I want you to keep the corks in the champagne bottle, because, the newspaper's reporting how I'm forecasting a double-digit increase. That double-digit increase still only takes us to about 300,000 home sales compared to about 510,000 a few years ago, right? It's because we're at such a low base. If I have a dollar and Wendy gives me another dollar, right, I just got 100% increase, but I've still, can't afford a Happy Meal, essentially. That's kind of where we're going to be at on the sales forecast. Yes, getting better. No, don't take your foot off the gas. Meanwhile, for buyers, prices are only going to get worse. We have the median price increasing 7.5% this year. I personally think that's conservative. And you can see that we don't have rates coming down dramatically by the end of this year, meaning that affordability is going to get worse for you. The combination of higher prices and rates that barely budge means that you spend more money every month or can afford even less house than what you can right now. So forget about what your brother-in-law told you, and remember, housing is a long-term game. The benefits of home ownership are completely unmarred by all these current ups and downs in the economy. That's why, I am putting my money where my mouth is, and I'm actually, again, selling my house, and I'm going pending. Well, I'm already pending. I'm closing on my new condo now at a 6.625 rate. And again, if rates drop to 5%, nothing's stopping me from going out and taking advantage of that. And now all of a sudden I got a killer new truck on the basis of those savings. So, I think that is the moral of the story. Step up your game and really bring it. And if you do that, I think sky's the limit. You just can't rest on your laurels and take it for granted and throw it on autopilot and think you're going to ride the wave to your best year ever. It's just very much an elbow grease environment. But again, if you do that, I'm not worried about any of this stuff when it comes to your ability to be super successful. I saw Rafaela sent me a private comment about sharing some of my personal details. I apologize if that was sensitive. I just think a story kind of really encapsulates, and you've got a lot of life events that kind of lead people to sell, despite the fact that there might be like structural financial reasons for them to stay in the home. It was just my way of kind of putting some color around why we should expect inventory to go up. So sorry if that made you uncomfortable, but I appreciate it.